All right, let's get straight to it. While the US was sleeping, the Asian close just fired a massive warning shot. We're looking at a staggering negative 5.96% drop in Korea's KOSPI. Now, this isn't just a bad day. This is the sound of the entire US AI valuation model fracturing. A new systemic risk is now active. Let's put a number on this. 3.2 trillion won. That's how much foreign capital just sprinted for the exits. Look, this isn't market noise, and it's not a minor dip. This is a high-conviction capital flight, pulling directly from the heart of the global AI hardware supply chain. The signal couldn't be clearer. So what does this look like? Take a look at this heat map. That sea of red you're seeing, that's widespread, indiscriminate selling. It's not isolated. This is the first real physical evidence that the whole AI growth is infinite narrative has just hit a brick wall. Big money is deleveraging, and they're doing it fast. And that wave is heading directly for the US Open. Okay, so what sparked this fire? It all comes down to one number, a 15.47% spike in crude oil. Now, you're probably thinking, wait, what does oil have to do with tech stocks in Seoul? Well, it turns out everything. The link is direct, it's immediate, and it's what forced this massive liquidation. This is cause and effect, plain and simple. And this brings us to the core of the issue, what I'm calling the HBM energy paradox. This is the concept you absolutely need to understand today. It explains why the shiny digital world of AI is still completely chained to the gritty physical world of energy. So what is this paradox? Simple. AI runs on powerful chips. Those chips run in massive data centers. And those data centers, well, they consume an absolutely insane amount of power. So when energy costs explode, the operating expenses for these tech giants go parabolic. All of a sudden, investors are forced to ask, what are these companies really worth if their biggest costs just went through the roof? Let's break down the chain of events. It's a four-step domino effect. Step 1, the energy shock. WTI crude blast past $100. Step 2, the OPEC's threat. Suddenly, data center operating costs are a massive problem. Step 3, big tech signals CapEx cuts. They're going to buy less hardware to protect their bottom line. And step 4, supply chain liquidation. The smart money hears that and immediately dumps the hardware suppliers. That is exactly what we just saw happen in Seoul. Now, this is where it gets really interesting. That money didn't just disappear, it rotated. While the digital supply chain was getting hammered, we saw a critical divergence. Capital fled from intangible assets, digital chips, and poured right into tangible physical assets. We're talking about a move from digital chips to physical ships. And here is the visual proof. On one side, you see capital dumping HBM tech, the very heart of the AI revolution. And at the exact same time, on the other side, you see that money flowing into tangible assets like massive transport ships. This is the HBM energy paradox playing out in real time, a clear flight to safety from the digital world back to the physical one. But hold on, there's one variable, one massive wild card that could flip this entire script. The G7 is holding an emergency meeting. What are they talking about? A potential coordinated release from their strategic petroleum reserves. If they do it, they could slam the price of oil back down and reverse this entire bearish factor. This policy decision is the catalyst to watch for the US session. So here's the setup. You have the physical supply chain screaming sell, but you have a potential G7 policy intervention that could trigger a massive buy signal. This is the central conflict. This is the tactical problem you have to solve before that opening bell rings. Okay, let's get into execution mode. Remember the rule. Do not trade the headline, trade the supply chain. With that in mind, let's lay out the tactical map for the NASDAQ 100 as we approach the US Open. Here are the levels. The bullish entry condition is a G7 SPR release of over 400 million barrels, targeting a break above 24,800. The bearish exit condition is any policy delay or a failure of support, triggering below 24,200. The zone between those two levels, that's the volatility chop zone. That's your signal to stand down and wait for confirmation. All right, final checks before the 0930 Eastern Open. Here's your execution checklist. First, watch pre-market volume on NASDAQ futures. Second, confirm price stability above 24,500. Third, invalidate any long positions if 24,200 breaks. And fourth, monitor WTI crude for a reversal back below that $100 mark. You log the result at 0630 Eastern, no exceptions. The signal from Asia has been sent. The only question left is whether a G7 policy move can override the physical reality of energy costs.
The first few hours of U.S. trading will provide the answer. If you want to get these signals before the opening bell, you know what to do.